Welcome to my channel. Time for Bitcoin.
A depression is when there's not enough money for the demands. So what happens is the opposite of the debasement. Assets get devalued and currency, which is the thing that's in scarce supply, but the money is the thing that everybody desperately needs. When that is extreme, that's a depression. What we're seeing now is the opposite. So we've got inflation, but they've reduced liquidity to try and cool the demand. And people want preferring to try and get hold of money as opposed to assets, and the price of assets has gone down. So they've actually done the opposite. Quantitative tightening is the opposite of quantitative easing. So theoretically, if quantitative easing causes assets to go up, then quantitative tightening should make asset prices go down because you're making currency scarcer. It's all about this marginal propensity to consume or to save or whatever, and that's your expected future value of money. The reason there's not a lot of velocity of money in Bitcoin, there's a lot of hodlers, is that the general view is, well, I'm going to be better off if I just hold it. Right, which is why nobody's going to use Bitcoin as a transaction layer, apart from Lightning, because it's just the blockchain rails. But why would you? Because nobody wants to be the Bitcoin pizza guy. So you don't. So it's actually kind of deflationary in that respect. All of this is a game. It's a game of who are the other competitors in this game? The rules, as you would call them, right? Okay, we've got the central banks, they want to do one thing to us. We've got the asset prices, and they can do another thing based on whatever's going on there, you know, if you're investing in commodities or equities or whatever. And I need to navigate that to get to where I want to get to. And I have this base assumption that my cash is going to be flat. So I put 10 grand in a bank. I'm assuming my 10 grand is worth 10 grand. We know it's not, but in a 1 year time horizon, we don't really care if it's worth 2% less because we don't notice that. So then we're looking at the other levers and saying, okay, what is going to deliver what Tom wants, which is I want my money to offset debasement, not inflation, because crypto's done a terrible job of that, as has everything, including gold. I mean, virtually nothing offset this inflation we've just had. So that kind of took us all by surprise. But the debasement, well, I just divide all of these assets by the Fed balance sheet. That's really interesting. The S&P kind of goes nowhere. It's right at the bottom now since 2008. So as they started using the Fed balance sheet, debasing the currency, the stock market has just accounted for that. The Fed balance sheet's been doing that, the stock market's done that, but actually they've netted each other out. You haven't got any richer. Gold failed. You've actually got poorer versus the Fed balance sheet, probably because of crypto. So people just had a less marginal propensity to use it. In a digital age, gold is not actually that useful. The Nasdaq did actually pretty well. We're still not back up to 2008 levels, 2007 levels, but it's been going up. Why? Technology. Technology is a secular trend. The S&P 500 does not have a secular trend behind it. So, and then when you put crypto is the only thing that's really outperformed, because what you've got there is you've got technology and this kind of whole network adoption model, and it works really well for debasement of assets because it's scarce. Technology companies aren't scarce, really. You can just keep building them, but you can't do it here. So it works phenomenally well. So you're taking the bet that future Tom wants to not have screwed up, and therefore future Tom wants to choose the asset that he thinks best represents the set of risks that he sees that being played at the table in the game. And that risk to you is debasement of currency, which I think is probably the larger risk. And therefore, Bitcoin or crypto is the best bet to take. But it depends what future you is, depending who's watching this and what they need. Because some people want to protect, some people want to grow, some people want to, there's different motivations. But generally it's protect what you've got so you can maintain your level of who you are, because nobody wants to ratchet down the reality or their expectations of themselves.
Raoul Pal is the CEO and co-founder of Real Vision and the CEO and publisher of the Global Macro Investor. He was co-manager of GLG's global hedge fund in London. He was one of the few investors to predict the 2008 mortgage crisis. In this episode, he talks about the future of the economy, technology, and the aging society, and what challenges it poses to us in the near future.
Who is hoarding money? Baby boomers. The same people who caused the inflation are causing the deflation or disinflationary trend. Because they're hoarding money because they're now 75 years old. And all you want to do is make sure you don't die destitute at 85 or 90, right? Imagine if you're homeless at 85, right? So you are driven by one of the strongest psychological factors you have is, I cannot get any worse than I am today, right? So you're a hard stop. So you won't spend. So the baby boomers have stopped velocity of money. And I've proven this with charts over time that that's what's causing it. That's why we've got this disinflationary trend in the world, even though we're in a temporary inflationary trend. And it's been that the Fed have debased currency to try and offset. The baby boomers have, and I did this whole long 2.5 hour thing that people should watch on the Real Vision YouTube channel with Robert Breedlove about why we got here. It's a very long 2.5 hour video and I can't tell you how important it is. But the baby boomers, with the debasement of currency over time, found that their income didn't go up, but the assets did, because there was too many of them competing for these assets. This is before debasement. And so they borrowed money to fund the gap when we started the big debt boom. It was all driven by this demographic. So that's a big issue here. It's a bigger issue with this demographic game, because that's one of the rules of the game that you can't change. So when my dad retired, Dad used to quite like spending money. You know, he was reasonably, he was a middle class, did reasonably well. Not phenomenally well. And what happened the moment he retired, he's like, fuck, this is a fixed sum of money. I don't know how long I'm going to live for, and my wife's probably going to outlive me. So his spending pattern probably in 2 years fell 65%. Oh. He was the guy who'd buy champagne. He'd go out for dinner with friends, buy a bottle of champagne, whatever, blah, blah, blah. By the time he hit 76, he'd be on the €5 special at the supermarket because he just didn't want to not run out of money. The worst thing for him is him to die, which he did, and leave my mum with no money. Because then his whole sense of self is tied up in it. So anyway, so it's really strongly driven by these kind of things. So I think as they get older, it actually gets worse. So then we've got the other issue, right, which is depopulation of the world, right? That's coming at scale. But this gets offset by technology. So if you look at Amazon warehouses, Amazon is employing robots at a faster rate than humans. And the robots, there's now 500,000 of them, and 1.5 million people work for Amazon. But the robots work 3 times as many hours and are probably twice as productive. So, and they never have a holiday, nothing, right? So that's going to happen at scale and replace the baby boomers. There's one economy that's led everything, that's Japan. The issue is that people start living longer. The Japanese actually passed on the wealth to their retired kids. That was the problem. Because if you lived to 90 and you had your kids at 20, your kids are 70 by the time you die. And so they didn't get the wealth effect of the changeover in wealth. Now, not every economy is as long living as Japanese, and the Americans are 42nd longest living. It's inexcusable. Considering GDP, how much they spend on healthcare as a percentage of GDP, it's inexcusable what happens in the US. But so I don't know if there's a big wall of money coming, and I think people's jobs get replaced by technology. But I think there is a productivity boom, which we've not had for a long time because of this retired population and debt. I think this, what I call the exponential age, this rise of technologies, may give us more wealth per GDP. So it'll manifest itself in ways that we don't know. Now, it doesn't matter if it's stuck, right? Because as long as in a pension fund that's investing in VC, that's driving technology, it's okay. I mean, the worst thing to happen is for you spend it on bags of chips and cans of drink, because then you're creating food inflation. What you actually want is it to create GDP growth. So by pension funds lending it or giving it, investing in companies, VC companies, you're fueling new technology, new wealth, new GDP.
What do you think about what awaits us in the near future? Will the markets pick up or will we face a long recession? Let me know in the comments what you think. Thank you for staying until the end. Please like and subscribe if you appreciate my work.